Good Tuesday morning, Market Chameleons. Thanks for joining us. And for those joining us for the first time, welcome to the Market Chameleon pre-market show with myself, Will McBride, and soon to appear the King Chameleon, Dimitri Pargamonik. How you doing, Dima?
Hey, Will, how's it going?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing our ideas. If you need professional advice, call your registered investment advisor or call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. And with that, I think we could get started.
All right.
So what we'll do today, we'll open it up for Q&A again. You know, anybody has a question out there, could be Market Chameleon tool, analytics, strategies that are working for you, you'd like to share with us, things that you tried that didn't work and you wanted to come on the show and talk about it. You know, you're welcome to come on here. There are two ways to ask the questions. You could put that in a live chat. Will's monitoring them. He'll read it back to me. There's also a Zoom link. You click on it. You come over to Zoom, you raise your hand, you could ask your question directly. You don't need to turn on your video camera. And this way everybody benefits in the community, because if you've experienced something, most likely somebody else either experienced it or will eventually if you're trading. So again, this is a way to benefit everybody in the community. And we've had some good questions, you know, along the way. What I'll do today is, while we're waiting for questions to queue up, I'll go over pre-market report. We could talk a little bit about leverage and margins. I know I haven't covered that a lot, and you know, it's a little bit more, I would say, sophisticated concept in trading, because a lot of trading, if you start doing it like a professional, it revolves around borrowing costs, cost of carry. It's very important. I think a lot of people who get into it, trading in the beginning, think of trading more like directional only and, you know, speculative ups and downs and stuff. But borrowing costs, leverage, cost of carry, are very important to traders, and we'll go through kind of an example. I'll start it out, see what kind of questions we get here, and how options can help with that. Okay, so if we don't have, let's start out with the pre-market report, then we'll go on. If we have questions, we'll do that. If not, I'm going to move on to talking about that leverage and margin. Sound good, Will?
Yeah, perfect.
Okay. So this is the pre-market report. These are stocks trading in a pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, I see 126 stocks made our percentage gainers list, 28 on a percentage decliners list. So from that perspective, we're looking like a more bullish bias for the open. Let's take a look at the S&P 500 stocks if we see a similar situation there. So I'm going to come up here to the filters, and I'm going to drop this down and look at S&P 500 stocks. So by selecting SPY, these are the SPY holdings here. And I see 15 made our percentage gainers list, 5 on the decliners. So 3-to-1 ratio looks like we're setting up for a more bullish bias at the open. If there are no questions, I might just start talking about then that next piece.
We did have a question from Robert. Really, okay. It was the first comment of the day. He was asking, he says, Will, do you and Dimitri have any suggestions for when you would exit a profitable trade? Do you use percentages? Do you set up an automatic sell price after you buy an option, etc.?
Right. That's a good question, because I do get that question a lot. Well, when do you exit? You know, and I think that it's always depends on the circumstances at the time, right? So you're always reassessing the new information. You're reevaluating how does your portfolio look, because it's not just the trade to me, it's my overall portfolio and how it fits in there. But to answer, there are things that I do. Sometimes when I do see a profitable trade, let's say, and I tend to go mostly from the long side. So I buy and sell options, but I tend to lean more from the buy side, long options. And when I see certain options that performed really well, you know, 4, 5, 6, sometimes 10 times, you buy an option for $1, it goes to $5, $6, $7, $8. When that happens, and if you're trading, enough you're gonna have losers, you're gonna have winners, but that happens, I start to take a look at that and try to reassess it. And one thing, if you're not sure, like if I'm not sure, I'm like, I think this is, this has more to go, but it could go down. Whenever in a position where I'm not sure what to do, I kind of take half of it off or some of it. So it's never, this way. If it goes back down, I did something, I'm not as upset. If it goes up, I kept something, I'm not as upset. So anytime I'm ambivalent, I take some off so I could think about it. But this way, I'm not all in. Other times I might feel like, hey, you know what, this thing ran up a lot. I don't know, some of these indicators I'm getting, we might be toppy here. So if I'm afraid, I'm more afraid, I might just roll. I might just take, if I think it's going to continue, I might just take, something off for $8 that's in the money and look at an at the money or something cheaper just in case, but take some, take a lot of it off. Or other times I might just say, hey, it went up. I think it's going to kind of settle here. So I might just sell something against it. If I'm long an option and it's deep in a month, maybe it's like, now it's a 70 delta, or whatever. I might sell that the money, because this way, if it goes down, I sold something. If it sits there, I kind of, make that premium. If it goes up, I still have kind of a call spread. So it really depends. I don't have a set rule, and it'll depend on my overall portfolio. So I don't look at just option trades in isolation all the time. I look at the overall portfolio and how it fits in. Because if I have too many longs, obviously I'm looking to take it off, right? And if I don't have enough longs, I'm not taking as much off. But those are like kind of some of the things I do. So I don't think it's ever a bad idea if you're ambivalent to take some of it off. There's no rule that you have to be, either all in or all out. There's no such rule that you're allowed to do. You're allowed to do partials, right? Or I'll trade around it. I'll look at the board around it. I'll reassess the situation. I'll take a look at, if I'm in semis, like what are the semis doing? Do I think they're still strong? They have more room to run. Do I think some of them are starting to turn back? I might unload some. So I'm always reassessing. Okay. Does that help?
Yeah, that's super helpful, D. Thanks.
Yep. And again, it's kind of, you're now looking at risk management, right? And that's kind of a different aspect of trading. We talk about, one part is education and experience. Then you got research tools. That's where we come in. You have portfolio risk management. That's another tool. And then you got your execution, which is your broker. And sometimes, I don't know if some of these brokers might provide some risk management tools. But if there are no follow-up to that, Will, or let me know if there's a follow-up.
Nope, you can move forward.
Okay. So wanted to kind of talk about, we don't talk about this that much, but leverage and margin. And some people think leverage is like, well, I buy, I'm just buying a cheap call. I have leverage because it could just go up, from $1 to $10, which is true. But I'm going to explain to you the leverage that comes with where cost of carry is important. It's the borrowing cost is important, and how, as a retail trader, or how do we access lower borrowing rates? Okay, so I'll give you an example here. What I mean by leverage, and you guys might know. I think this is my notepad. So I just started writing it down. If you buy a property, right, piece of property for $100,000, well, what do you usually do? You borrow against it, right? So you get a mortgage and you put 20% down. So you're putting down $20,000. So this is your total outlay, $20,000, and you control $100,000 in of a property, right, of a house. And here, so keep in mind what you have here is a carry risk. This is a carry trade, because if you're an investor, you're going to try to rent it out. You're hoping that you break even maybe on the rent versus your whatever it costs you to carry it, and you're going for the appreciation. And this is where the leverage kicks in, right? Your leverage based on what you put in. So you put in $20,000. So imagine if you bought this cash and the house does appreciate, and if it appreciates to, like, say, 110,000, right? So let's just say it goes up by $10,000, right? If it goes up by $10,000 and you bought it cash, you made 10%, that's pretty good. But when you're leveraged, you put down $20,000, right? If this goes up by 10%, your return on what you laid out is 50%. So see, that's where you're using leverage. You're borrowing to carry risk, and there's risk because the price of the house could go down. You could have a tenant destroy your place or not pay you rent, so you have this carry risk. But if you're using leverage and it goes your way, that's where you get this enhanced return on your investment. So if this makes sense, now we're going to translate this into stocks. So let me know if you have any questions here. But this goes from a 10% return, if you're doing full cash, to a leverage of 50%. Okay, and you call what we call this is carry risk. Okay. So how do you do that in the stock market, right? If you can do that in the housing market, you can get mortgages, but how do you do that in the stock market is the question. And the first thing we want to do is, stock market operates a little bit differently. You can't get a mortgage, right? You can't really rent out your stock. Not right now. They won't let you loan out. If you can't lend out your stock right now, the broker does it. They rent it out and they earn that rent. So you can't get rent for it. You can't get a mortgage, but there are certain things you can do, right? And you can borrow to buy stock. But as a retail investor, you're at a disadvantage and it won't work. So you got to look for a different place. So, for example, let's just say, what is the annual? If everybody's okay with this, I'm going to delete this out. Okay. So I'm going to delete this out. And let's say, what is the annual return on the stock market long term? 10%? Well,
yeah, that's a good number.
All right. So if it's 10% per year on average, if that's what you're expecting the market to go up, right? Average, market return long term. So it'll go down, go up, but on average it goes up 10%. So if you're in it, full cash, 10% is pretty good, but how do you use leverage? For example, how does Warren Buffett why are his returns so much higher, right? If the market's returning 10% and his portfolio looks very much like the market, right? He's very diversified. He's got big cap stocks in there. So how's he getting all these enhanced returns? Well, he's using leverage, right? He's borrowing at a very low rate to leverage up on the market, right? So I think where is he borrowing from? Well, besides going to the banks where he can borrow at low rates, I think he's also using his more insurance companies, right? Using the leverage from the insurance companies to get loans.
Yeah, he's probably using the bond market too, commercial paper.
Right. That's why, just like I just showed you, that's where he's enhancing his returns in the long term, right? So that, just like I showed you, you could, one way you're fully invested, you're making 10%. Another way, if you're leveraged, you're getting, 50%, maybe 30, 40. So let's say if you could get 10%, and you could carry that risk, theoretically, if you could borrow below that rate, buy the market and get 10%, then that's where, you're making that spread, right? Now, I don't like, if it's 10%, if they say 10%, really, for me, I look at it, I need a cushion. So I might say, I need to think of like maybe 7% or 6% returns. Like that's where I kind of come in, and I need an edge. I don't like to, forecast the very best situation. I need a cushion, and I'm looking at, if I'm borrowing, I need to probably be below this 6%, maybe 5%, but let's just stick right now for this example, 10% leverage, which means that if I'm getting long, SPY, and I'm going to hold on to that carry risk, I need to be able to borrow under this. So far, everybody okay? This is the first time I'm explaining this. So if there are any questions, well, let me know. Right. And so then I start looking, I'm like, okay, where can I get leverage? Where can I get a good borrowing cost for this carry risk trade, right? It's a carry trade. So I'm just going to show you kind of, and I was just thinking, like, what is a popular, and I'm not picking on TD Ameritrade, I have an account there as well. I'm just showing you, popular place that traders have accounts, and here's TD Ameritrade. And you could see here that this is as of March 2020. They haven't updated this yet. This is what I found. But here you could see that whatever the base rate is, whatever their base rate is, they give you pay another 8.25%. So they'll show you here, here's a base rate, and it's about an 8.25% above it. So they give you these different ones. So about 8, let's just call it 8%. And that becomes prohibitive, right? To me, that's prohibitive because I can't rely on, borrowing at 8% if I think that, okay, even if it's 10%, I need some cushion there. 8% is too high, and how much do I put up, right? To carry it. So to me, this is very similar to what's going on in the retail space, right? So if you're facing that situation and you're interested in a carry trade, and I'm not telling you to go do it, I'm only demonstrating this to show you leverage and how to find lower borrowing rates using options. Okay, this is just a demonstration, guys. So don't go out doing this. Because I don't want them people saying, "Oh, I did this and the market fell." But now I'm looking at 8%, and I'm trying to scratch my head and say, well, I can't really do that. That's not a big enough margin for me, especially if I'm, it's too close, right? That's just too close for me. So I got to find somewhere where it's more competitive, that I could get it really low, that I have a good margin of cushion, so I could carry it for years, potentially, to wait for that market to to go above that rate. All right, so far, everybody with me on it? Hopefully.
Yeah,
So
everyone looks good, Dave.
okay. So I'm going to come back here. Oops. Before I put up my calculator. So what I need is thinking, okay, I got to go, I got to go below that. I got to find somewhere where I could borrow lower than that if I'm doing the spread, the interest rate. And another thing that there are two types of accounts. There's a Reg T account where you got to put up 50% of the collateral. There's a portfolio margin account where you put up a lot less. It might be like 20%. It's kind of closer to that mortgage, that I was showing. All right. So
but the thing with the accounts is different amounts of money required for each one, right?
Different amounts of, right. So your collateral, it's different. I'm not going to go into it this time, but there are more advantages based on what type of account you have. So portfolio margin account has more advantages than a regular Reg T account, but you have to have more money in that account. But I'm going to show it to you kind of from the perspective of a portfolio margin. And you don't want to lever up too much because the market could go down and you're going to get called on it. So maybe, you do like a, 30%, right? I'm going to put up 30% of the collateral, and I'm going to leverage the rest, something like that. Do 50%. So if the market falls 50%, you don't go called in. But, in general, what is the market? A really bad sell off 20-25%. It's like a really pretty bad sell until like the Fed really kicks in and starts stimulating. So let's just stick right now with that at 8%. Now I'm going to show you, and here's the thing in the options market. Why we look in the options market is that the benefit you have in the options market is that there are competitive broker dealers, right? So there are dealers who have access to very low interest rates, very low borrowing costs, and they compete in the derivatives market. And that becomes an advantage for people who do not have access to lower interest rates, right? So if I'm a broker dealer and I could get, like Goldman Sachs or Merrill Lynch to clear me, my borrowing cost might be like, 0.5%, less than 1%. But there's no way as a retail broker I could go in there. But the benefit to us is that those broker dealers are also competing in the marketplace, which tends to bring those rates down. Now I'm going to show you what I mean by that. Okay. So as long as everybody's with me so far, I'm going to move on. And I'm going to show you, I put up Amazon, and the easiest place to show you this is I had to kind of find a simpler example because I have to take the dividends out there, because if I have to go into how do you compensate for dividends, it becomes a longer show. But here's Amazon. I'm going to go here into the options chain. And let's pretend Amazon's like, well-diversified portfolio, right? You're doing this well-diversified portfolio like SPY or whatever. Just SPY has dividends. That's why I didn't want to do it there. And I'm going to go out a year in these options. So let's go out to, so I don't have exactly a year. So here's a year out, almost January. So this is January 20th, 2023. Okay, 244 business days. So not exactly a year, but close, maybe a week away. So if I had to do this in Amazon and carry it, right? Amazon is 2,990. Let's just say 3,000, just to make it easier, right? Let's say Amazon is 3,000. How much would it cost me to carry it? So I'm going to bring up my calculator. 3,000. I'm going to buy one share, $3,000. And to borrow, right? My borrowing is 8%. So times 0.08. So $240. So that means it's got to increase by more than $240 for this to make sense if I'm going to use leverage and borrow, right? and it, again, because it's 8%, but we need to get that down, right? Because really, like, to me, that's high, right? Especially if the market's like at average 10%. And I'm using Amazon as like a well-diversified, that you're doing this spread out and you basically have the market. So this is high, and how do you get this down? And this is where I'm showing you why the cost, the carry cost is important, right? And why we're looking at the options. Because in the options, I could basically get a synthetic long. So synthetically, I could buy that stock and pay the borrower rate in the competitive marketplace. So this is because the options are competitive, right? They have all these dealers buying and selling and bringing it in. So what would it cost me? What would it cost me in the market? So let's take a look here. So $240. Let's say it's around $3. It's $9. I'll adjust for it later. We could have adjusted the $9, but let's say here there's the strike 3,000. So if I'm buying the call, right, here you go. I'm buying the call. That means I'm getting long, right, going up. And if I sell the put, right, that means I'm also getting long. So on the way down, I'm going to be at expiration. I'm long the stock 1-for-1. On the way up, I'm long the stock 1-for-1. So synthetically, I got long the market. Instead of buying it outright synthetically, I got long the market. And so what does it cost me? So here's what I'm paying. I bought the call, $375, sold the put $341. If on the market, I paid $34, midpoint $26.70. So here's the cost. Here's the cost that the stock has to go above for this to be profitable in a year at expiration. That's in the market, in the options market, $34 versus the cost of borrowing it from the broker, $240. Do you see the difference, guys? The cost that the stock has to go above for this to be profitable, it's almost 10 times. So when you're dealing with this, the demonstration is that why the cost of carry is important. Why the interest, why, some people get these enhanced outsized returns. It's not because there's so much better stock pickers, and he might be a better stock picker, maybe Warren Buffett isn't, but he has the ability to use leverage, right? Access to cheap capital to enhance his returns. And that makes a difference. Or just like, if you're buying properties and using leverage in your mortgage. Now, I'm not telling you what to do. It has to, you need a lot of experience and education to learn, but I'm just showing you the beginnings of it. All right. Does that make sense to people? Well, it
looks like it does, Steve.
Okay. So that's quick way I wanted to demonstrate. You got, a very big discrepancy between, where the rates are offered in a regular, retail account, Reg T account, maybe even like portfolio margin versus the real market rates to broker dealers. And one way to access that competitive market, if you know how to do it, is by using, where the option, where you could participate in the competitive market.
All right, that was awesome. Margin and leverage. Very good educational piece, Dima. Thank you so much, my friend.
All right, thanks everyone for joining. Stay safe out there. Have a good trading day, and hope to see you guys tomorrow.
Trade in peace, chameleons.